Hello and welcome back to my YouTube channel. Today's topic is that this market dip won't last long. And for you to take advantage of it, it's important that you fix your bad money habits. The markets are falling and today everyone is in pain situation. The blunt truth is such events have happened multiple times in past and it might even happen in future. The current dip won't last forever. And the worst thing that you can do is to waste it. See, right now, the markets are reacting to Middle East conflict fear, sudden jump in oil prices, and that has hit India hard because we import most of our oils. That is reason what has caused was the increase in oil price impacts lot of businesses, a day-to-day necessity, making it very expensive. So let's see how we can handle this. Before that, let me tell you, even though markets are down and fear is up, this presentation is not about stock tips. It's about the habit that you have to build so that you can take advantage of each market dips and build your wealth over time. The most important point is झुकेगा नहीं. That should be your portfolio. Your investing plan should be such that it does not have to bend down in scary times. So, when you think of building a portfolio, keep this thought in mind. Pushpa, झुकेगा नहीं. Now, let's understand the context. What's driving this dip? In over past couple of days, the market has dropped sharply, and India's Nifty and Sensex have been down maybe 5 to 7%. The pressure is linked to oil's increasing and exponential selling pressure in the market. The global markets have been shaky because oil and gas prices have jumped on warfare. This is not that India suddenly became a bad country for investment. Basically, this is a global fear, and fear moves the market faster than logic. So, what's the big truth here? I'm not saying that market will bounce back tomorrow. Nobody knows that when the market will bounce. But historically, fear event fade. Either the situation stabilizes or market adjusts to new reality. What does what does last longer is your behavior with respect to money. Panic selling can damage you for years. Bad habits during dips create lifetime regret. So don't try to predict the bottom. Use the dip to fix your process because the dip won't last. And any wrong behavior that you have with respect to managing your finances would last longer. So here I'm going to share with you 7 investing habits that you have to focus on so you can take advantage of current market dip. First, stop watching market like a TV serial. If you check price 20 times a day, you will behave like a trader even if you are a long-term investor. That let's make it a point that if you want to invest in any stock for a long term, you will check your portfolio only once a week max. The news is loud, the news channels are loud, but your plan should be quiet because the market is designed to test your emotions. Let's go back, let's evaluate the next habit. Separate your emergency money from investing money. This is where most people get trapped. If you invest money that you might need next month, every dip feels like a danger. So make a simple rule to have an emergency fund of 6 to 12 months of expenses and let this fund lie in a low risk portfolio or even in your bank account. Keep this money extremely safe so that your day-to-day necessities are not getting impacted. Second, keep an investing money in a separate fund, only money that you can leave alone for years. When you have emergency money, don't panic sell in a downward going market. So when you separate your emergency money from investing money, you are mentally less stressed because you know your day-to-day needs are being taken care of and your investing money is there to support your future growth. Third habit, SIP discipline beats bravery. So during day, people usually ask, should I stop my SIP? I would say no. Most of the time, stopping SIP is a self goal. SIP works because it forces you to buy more units when prices are lower. The market dip is literally your time that you put in more SIP that will help your portfolio to become more powerful. Keep one simple rule. If your job income is stable, protect your SIP. If your income is unstable, adjust SIP but don't fully exit unless forced. Habit number 4, don't average down blindly. Use stage buying. Buying more during dips is smart only if you have plan. The bad version would say, market fell, let me throw all my money now. The good version would say, stage buying. Now let me explain you what is stage buying. Stage buying means keep some cash buffer aside. Add gradually. 25% now, 25% if it falls more, and keep it in a staggered manner. Never use emergency fund to buy the dip. Never. This will ensure you that you don't have a sleepless night. Habit 5, rebalance instead of panic selling. Most common mistake is selling the loser in fear. The smarter habit is to rebalance it. If the equity fell and debt stayed stable, your portfolio balance changes. Rebalancing means you bring in back to your target, like 70-30 equity debt allocation or 60-40 equity debt allocation that we discussed in another video where I have explained you about how to evaluate investment term. What does asset allocation mean? If you want to know more about rebalancing, I would urge you to go back and see the video on investment terms. Would say rebalancing also mean you can buy low automatically without drama. This is not how institution, this is how lot of institution behaves. So when there is a scenario markets are going down, they make it a habit to rebalance their portfolio, to bring it back to the original debt equity asset allocation, to buy low without any additional drama. Habit number 6 is to avoid leverage. Leverage would mean making an EMI investment or buying on credit card, taking a credit card loan to buy equity stock or invest money in futures and options. In dips, leverage becomes poison. If you invest on borrowed money, even a normal dip feels like a crisis. So make it a normal rule. No margin trading unless you are a pro. No credit card investing. No personal loan to invest. Make it a loan because leverage removes patience and investing needs patience. So if you borrow and you invest, this dip is definitely going to break you. Habit 7, buy the dip checklist so the emotions don't drive you. Here is a simple dip checklist you can follow. Did I have emergency fund intact before I made investment in this dip? Is my SIP still running? Am I diversified or overexposed to particular theme? Is my allocation still on target? Am I reacting to headline or following rules? So this is buy dip checklist. When you follow this, you are following a strategy that will help you to make correct investment decision and you are not getting driven by your moods. So these are the 7 habits that I would urge each one of you to follow when you're buying dip and when there is a panic selling in the market. A warning what not to do. This is one of the most important thing. Let's be blunt about mistake. Don't sell quality long-term holding just to feel relief. Don't move everything to safe asset after the fall. Don't chase war stock or hot tips because of fear headline. Don't try to recover losses quickly with risky bet. A dip is not a casino invitation. A dip is an opportunity for you to buy stock which is repriced by because of market dynamics and help your portfolio grow at much faster pace. So here I would urge you to have this simple action plan for next 7 days, which is first determine what is your target allocation. Confirm the emergency fund. Keep your SIPs running. Remove leverage exposure if any. Set a portfolio check day, which would be a weekly, maybe Thursday evening, Friday evening, or any of a day on a weekend that helps you to focus dedicatedly on your portfolio. And decide your stage buying role, how much you will buy when there is a fall in market. Getting clarity about your habit and your financial goal will help you to make best advantage of current market dip. So I would say to summarize, the dips are temporary, habit is permanent. And to make best use of this current dip, follow these 7 habits. Less screen time, separate emergency fund, continue your SIP discipline, ensure that you get into stage buying which is comfortable to you. Focus more on rebalancing than panic selling. No leverage at all cost. Lastly, all decisions are checklist driven and not emotional driven. Because Jukega nahi should be your mantra when it comes to your portfolio. Your plan should not bow down to fear. It should stay erect even in case of any emergency. I would urge you to comment below. Are you an SIP investor or lump sum investor? In this dip, what is the hardest thing for you? Is it your fear? Is it confusion? Or you get into the zone of impulsive buying? I would like to know your views in a comment section below. And if you think this video would help or benefit your fellow friends, your colleagues, or anybody are in need and who want to make best use of current market dip, do share this video with them. Thank you so much for watching this video.